Everyone is trying to make crypto seem very complicated, too difficult, but you actually need only three things to succeed. But before we get into those three things, I want to share something very important that happened yesterday, and that is the US Treasury, which is like the government's bank, shared plans to borrow a lot more money than expected. And this is called the Quarterly Refunding Announcement, QRA. It's where they explain how much debt they will use and what kind, if it's short-term or long-term debt. And why they're borrowing so much? You might ask. Well, the government's bank account, called TGA, is low, $300 billion. So they want to raise $1.6 trillion and spend $1.1 trillion by the end of this year. This leaves them with about $850 billion in the bank at year end. And what does this mean for the crypto space? Because this is what we're interested in. Well, this means that $1.1 trillion is going into the economy, which means more liquidity, and that can definitely be a good sign for the markets. But in the short term, this large debt drains money from the system, which can cause a lot of market volatility and uncertainty. But the important part, how they borrow, really matters. And as I said, they have the two ways. One is the short-term debt, the so-called bills, due in a year or less, and then they've got the long-term notes, bonds, due over many years. There are two scenarios to consider. The first one is borrowing mostly short-term, which is the preferred approach, and markets prefer this, but too much short-term debt can worry people about debt stability. And scenario 2 is borrowing mostly long-term, which is very unlikely, and it's hard to find buyers for long-term debt. Long-term rates go up, and also stock markets could fall. The ideal scenario would be a balanced mix, mostly short-term, but not too much, and this keeps markets calm and ensures that there are enough buyers. So that's on the side, but also this week we have the Fed Chair Powell speech. We also have the FOMC meeting. So the Fed, which is a central bank, needs to speak in a way that reassures the markets. And if that happens, then investors don't fear inflation from all this extra money and see it instead as a positive growth. This is how it needs to be sold to everyone else. So there is a lot going at the background, which is important for you to be aware of and to understand, because it all has implications on the economy, and economy, business has implication on the markets. And the US, as you can see now, is about to borrow a lot of money, and how they do it short term versus long term can move the markets a lot. If they manage it well and the Fed sounds supportive, positive, it can boost the market. But too much short-term or long-term debt can cause a lot of problems. Let's see how that goes. We'll be keeping an eye on this, especially on Discord. We're always having those useful discussions, so we can all have a clear picture of what's happening and how to act accordingly. Because what I'm going to say next is linked to you having strategies. And as I said, you only need three things to succeed, and one of them is this clear vision, structure, and strategy. Without a plan, you're just gambling. You need to identify, are you investing for the long term? Are you swing trading? What are your entries, exit plans? You need to have a clear vision of what you're doing. If you're just guessing, oh, tomorrow we're going up, today we're going down, it's not going to work this way. Having a plan, or at least picture based on strong fundamentals, on news, on fundamental analysis, on whatever analysis, technical analysis you want to do, fine. Just set it up and follow it and keep improving it as you go along. The point is that I'm trying to make, you need a framework, not vibes, which is what a lot of people miss. The second thing that you need is patience and emotional control. Crypto will test you. You'll see projects pumping 100% overnight and crash 100% in a week. You might buy a coin at, let's say, $1, and I'm sure this has happened to all of you. You buy a coin at $1, it drops to 70 cents. You panic, you sell. Obviously, probably for $1, you're not going to do that. But if you invested, let's say, $100 or above, you would see it dropping to $70. You would sell in panic. And then 2 weeks later, you would see it at your coin that you've bought 2 times higher than what you bought it. That's how people lose. Not by being wrong, but by being emotional. The best investors, they sit through the noise. They don't chase bombs, and they don't panic in the dips, but they see it as an opportunity and they stack and they buy low, they buy cheap, and they wait for their setups. They don't act on emotions. And the third, of course, is some initial capital. But you actually don't need thousands. A lot of you would think, oh, I need a lot of money to become rich. Well, you don't need 10,000 to start. You can even start with 100, and with the right place, with discipline in place, you can keep growing it. It's very possible, and I personally have a friend in the bear market who bought Solana at $8 with $200, and they grew that amount a lot right now. You know, just from holding, being patient, and putting some capital in there and holding it through. With $8, you know, buying something for $8 with $200 can easily, you can easily scale it to thousands. So you don't need to throw your savings, and I wouldn't recommend that at all. Start small and keep growing it with experience, with learning. This is the best you can apply. And if you start today with whatever you have, and you stay long enough, you're patient, you keep learning, you keep experiencing. If you go through one cycle, I'm sure you will be grateful for you sticking to the game. So I hope you found this video helpful. If you did, please don't forget to like, subscribe, and share. That's for me today. Thanks so much for watching. I'll see you in the next video.